To Marcellus Webinar on the double engine newsletter that we published a few days ago. This is effectively going to be our all-star webinar where all of our fund managers from our domestic portfolios as well as the global compounders portfolio are present and will be taking you through the various portfolios, but more importantly, the central idea for the webinar, which follows from the newsletter, how combining your domestic equities and global equities in a single portfolio can give you superior risk-adjusted returns over long periods of time. To give us the background on the double engine concept, I'll request Saurabh to take us through the double engine thesis, and then we'll have each of our fund managers talk through the portfolios as well. Over to you, Saurabh.
Thanks, Pramod, and thanks, folks. Thanks for joining us to discuss this. It's something we've been working on, right? This whole construct of how the whole world ends up buying products from a few companies. It's something we've been working on in the Indian context for now 10, 15 years. But in the global context, this is something that our global compounders team, Arindam, Shetty, and the rest of the global team has worked on. And we thought we should share with you just how startling the data is on how just a handful of countries and a handful of companies now dominate the world. So I'll get straight into it, right? We'll start with some background data on the two largest democracies in the world. If you start with the United States, as everybody knows, the largest economy in the world, nearly a quarter of global GDP. But I think what people don't understand, and certainly I didn't appreciate till 2-3 years ago, is that even though American real GDP growth is a couple of percent in the last decade, their stock market compounding is startling, right? So 2% real GDP growth adds, say, inflation over the last decade of 3-4%. American nominal GDP grows at around 5%, but the American stock market compounds at 17%, right? And we'll discuss today why that happens. Why is it that the entire world's economic growth actually feeds into the US stock market, right? 17% CAGR over 10 years is startling, right? Again, on India, everybody knows that we are the world's most populous country. That's a well-known fact that we are the world's most populous country. But perhaps a lot of people don't appreciate that alongside that, we've been one of the best performing stock markets in the world over 10 years, 20 years, and 30 years. In fact, over the last 10 years, we'll get into this a little bit more detail subsequently. We've been the world's third best performing stock market. Now, the combination is mind-blowing, right? It's the combination. That's why we call it double engine compounding, right? Nearly 43% of global GDP growth, but most startlingly, nearly 60% of the growth in global market cap. If you look at stock markets across the world, 60% of the growth in global market cap has just come from these two countries, right? So nearly two-thirds of global market cap growth over the last decade has come from the world's two largest democracies, right? And our thesis is, over the next 10 years, this combination, Indo-American combination, both in terms of a partnership between these two countries and in terms of these two countries being dominant drivers of global equity compounding, this theme will become a bigger and bigger part of your and my lives, right? And that's what we'll dwell on further. So let's get into why this is going to happen. Why is it that these two countries, India and America, now form the fulcrum of equity compounding globally? In fact, the data for the last 10 years suggests, as it is, 60% of global compounding is coming from these two countries. But I think things are going to get even more tasty over the next decade. So part of it, as I'm sure all of you are reading in the press, is what's happening with China, Russia, and America is easy to see. China effectively is committing economic suicide. They're going head-to-head with America. The sort of posh term or the intellectual term for this is the Thucydides trap. The Thucydides trap is when an emerging nation challenges the incumbent superpower. So America challenged Britain 250 years ago. Germany challenged Britain 100 years ago. And now it's China's turn to challenge America. The hegemon, the dominant power says, boss, I'm not giving way. The rising power says, Abhi tere ko main dikhata hu. I'm going to show who's got muscle. So that's the sort of posh term. Now, I'm not so sure you and I are that bothered about the intellectual constructs behind it. What we are more focused on the economic impacts of this. Now, there's this guy called Peter Zihan. He's an ex-CIA guy. He's been writing books on this subject for the last decade. You can go to YouTube and look up Peter Zihan. He's been saying for the last couple of years that China is going to be the fastest deindustrialization ever seen in human history. And honestly, till a year ago, I wasn't so sure how seriously I should take Peter Zihan. I read his book a year or so back, the book that we've shown here, The End of the World is Just Beginning. I read his book a year back, and he made the case there that China fundamentally relies on America, not just for capital. It relies on America for intellectual property. Most of the super bright Chinese end up studying in America's best universities. They teach there. And Zihan's point is, as China delinks from America because of its aspirations to global power, as China delinks from America, China goes into political disintegration, economic disintegration at a time when its demography is already aging. So a year ago, had we spoken a year ago, I would have been reasonably skeptical of this sort of doomsday thesis. But I think the last 12 months has been startling in this regard. Our Global Compounders team is an investor in ASML. We've given it here as an illustration. ASML, as my colleagues Arindam and Javi have explained in previous webinars, ASML is the dominant provider of lithography. So whatever phone or pad you're using to watch this webinar, the lithography on that almost certainly comes from ASML's extreme ultraviolet lithography machines. Over the last 6 months, America has made sure China doesn't get any of these. And effectively, America is sending China's tech industry back by 10, 20 years by effectively ensuring that the Dutch government, ASML is a Dutch company, the Dutch government puts export restrictions on ASML, right? Similarly, you'll be reading about how India has already banned TikTok. America is on its way to gradually banning TikTok. But there's another aspect I wanted to show you, and this is a sort of fresh story we've read in the last few days. I'll use the FT website. So if you go to the FT website, they're on the ft.com website, there's an in-depth story on this as to how America is trying to cut out Chinese cables from the global internet. So, the global internet, the internet across the world runs on undersea cables. The green lines are Chinese supplied cables. If you go to ft.com, you'll find the story there. This graphic is from the FT website. The green lines are Chinese supplied cables. The non-green lines are other countries' cables, primarily French and American, right? And what America is doing is, because America has realized that access to the cables gives China access to traffic, access to data, potentially confidential data, America and the Europeans are ganging up to cut China out from the cable business. They've already, many countries, including India, have made sure that Huawei and ZTE, the Chinese network equipment companies, are ostracized. Now, from network equipment, the Western countries are moving to undersea cables. Now, if I zoom in, right, you'll see what's happening. If you notice, in America, linking America, there's not a single Chinese cable. Thankfully, for us in India, you'll notice there's not a single Chinese cable for the Indian internet. But for example, if you take Pakistan, Pakistan's critical cable linking Pakistan to Africa, to Europe, you can see the Chinese cable. And obviously, if you go closer to China, all the critical cables in Southeast Asia, with data going in from China, are Chinese cables. The Chinese want to do more of this, and the Westerners are saying, we've blocked Huawei, we've blocked ZTE, we'll block you from supplying the internet cables. That's the level at which this war is being currently fought. It's a Cold War. Let's hope it stays a Cold War for the world's sake, for our sake. But it's a war nevertheless, and it's a war which has deep-seated implications for how economic flows will move. So let's get into our situation, specifically India. Right now, again, we've seen the backdrop. 2020 was Galwan, where this is where India, China, Bhutan meet, and China had China posted its army there. We had a punch up in 2020. Sorry, 2020 was Doklam. My apologies. 2020 was Doklam. Galwan was 2022, where the Chinese killed 20 Indian soldiers. They clubbed the Indian soldiers to death. You would have read about it. Assam Rifle Jawans. Earlier this week, the last Indian journalist was thrown out of China in a tit-for-tat row. You can go up and read the story. What we are hearing from our friends in Delhi, we manage money for some parts of the Indian government. What we are hearing from our friends in Delhi is that it's a pretty hot situation on the northern and northeastern border of India. And when we visit the defense establishments in both in Delhi and in South India, it's very clear that for cooperation on defense on advanced weaponry is going to pick up between India and China. My family and I, we visited the border near Tawang in Arunachal Pradesh. We visited the border in Arunachal Pradesh 3 months ago, and the Indian troop buildup is very real there. You can visit, anybody can visit Arunachal Pradesh. You need 2 permits, an inner line permit and a restricted area permits. You can apply for those permits. Thankfully, we got those 2 permits, and every 10th vehicle there is a Bofors gun, and clearly along India's northern borders, given the belligerent attitude China has taken, this is a very real standoff, and the more practical manifestation is things like journalists being evicted from each other's countries. Right now, for us and for the Americans, therefore, coming together makes a lot of sense. Right? If you look at India's defense expenditure, if you look at this table, India's military expenditure is 1/4 of China's. And therefore, to counterbalance China's weaponry, its military expenditure, we naturally need American weaponry. And as we are traveling around Chennai, the area around Chennai, the area around Hosur and Bangalore, it's becoming very clear that a bigger and bigger chunk of India's weaponry will come from the US directly or via Israel. These are offset contracts. The Indian government spends $100 billion a year on weaponry, imported weaponry. Under the Make in India program, under offset programs, American defense majors are going to supply a big part of it, and you will see plenty of this. Leaving aside weaponry, focusing on happier subjects, Tim Cook visited India last month. If you look at Apple's annual report, they make, I think, $220 billion of iPhones and pads. Tim Cook has said 1/4 of this could end up in India. That means India will end up with a $50-60 billion iPhone manufacturing industry. At the moment, I think we only make the SE, the iPhone SE. We make around $5 billion of it. Again, visiting the factories that Apple has started using outside Bangalore and Hosur, visiting some of the suppliers to Apple, we can see a massive build-up in economic activity there. Right? I'm sure many of you know that outside America, Microsoft's largest development center is Hyderabad, the Chivoli Colossal Development Center. Similarly for Amazon, and similarly for many other American companies. I think this morning I read Goldman Sachs' largest office outside New York is in India. Tata and Boeing have already signed the JV. It's near the factory is coming up near Baroda, where Tata Boeing are building defense aircraft for the Indian Army. So electronics, consumer electronics, electronic manufactured services, defense electronics, and the entire defense weaponry that our country buys. And the other area that we are seeing a lot of movement is in healthcare equipment, medical equipment, where we currently make only $2 billion of stuff, but potentially we'll end up making much more. Those of you who are Marcellus clients who have heard us talk about over the last 3 years as to how the API piece will move, active pharmaceutical ingredients. India makes $20 billion, China makes $200 billion. They are 10x bigger than us in API. Between these two countries, they make pretty much the entire world's active pharmaceutical ingredients. And as we keep talking to the American drug majors, the procurement heads of the American drug majors, the view is clearly given by the American drug majors. The US government wants the big American pharma companies to procure less API from China, more from India. So colossal is China's size that even if India takes 10% market share from the Chinese, our API industry doubles in size over the next 3-4 years. And I hope you can understand in that context why we like specialty chemicals and Divi's labs so much, right? So this coming together of two nations, America needs a counterweight to China. India needs America's weaponry. America also needs India's API. America needs India as a manufacturing sector for electronics. America wants to be a defense supplier to India. India needs those F-35s and the optometry and the circuitry we can get from the Americans. This coming together is inevitable. So if over the last decade, the two nations have accounted for 60% of global market cap creation. Our submission to you is in the coming decade, that 60% number goes towards 70-80%. Basically, pretty much the entire wealth creation in the world will be dominated by these two colossal democracies, right? And this is where the backward-looking analysis helps. So the US stock market we discussed has had a great 10 years, 16.3% total shareholder return. We haven't done too badly either. We've been number 3. The Americans have been number 1, which is why the two countries together have accounted for the majority of global compounding. We reckon these numbers improve, right? Whether America will be 1 over the next 10 years or India will be 1, I'm not so sure we are that bothered. What we are bothered about is, are we compounding our wealth, driving the underlying economic engines in these two countries, right? Now, we've done some maths to give you a sense of how powerful that would have been had we done this over the last 20 years. 20 years ago, Marcellus didn't exist. So this is a back test. So had you started 20 years ago, doing a 50-50 portfolio, 50% S&P 500, 50% Nifty 50, and had you rebalanced that each year in January, right, you would have compounded at 13.9% over the last 20 years, right? So 1,000 rupees invested 20 years ago would have become 12,000 rupees on 31st May 2023. But that's not the full story, right? Just the compounding per se doesn't do justice to the Indo-American partnership, right? The real fun is here, right? In isolation, the Nifty's risk-adjusted returns are all right, honestly, right? 0.66% as a risk-adjusted return is not a fun figure. It's by combining India and America that you jack up the risk-adjusted figures. Effectively, the S&P 500's consistency, the S&P 500 stability rubs off and juices up the risk-adjusted return. So in an Indo-American portfolio, the returns are driven by the compounding is underpinned by this, but the stability is underpinned by this. And the result is a diversified portfolio. You are not giving up too much return relative to an Indian portfolio, yet you are getting stability in returns. Your risk-adjusted outcomes improve very appreciably in an Indo-American portfolio, right? Remember, this is index investing. We're not doing active investing here. This is a 20-year look back. Simply a 50-50 portfolio gives you better outcomes than doing a national portfolio in isolation. Now, that was through a index compounding. Suppose we had done this over the last 4 years using CCP and GCP, right? Suppose we had done this over the last 4 years using CCP and GCP, 50% global compounders, 50% consistent compounders. Where would you have been, right? The answer would have been you would have been in a fun place, right? Very interesting place. CCP, these are real returns. We've been running CCP for the best part of 6 years now. So these are real returns, gross of fees and tax, just to give you like. GCP are simulated returns. The GCP real track record is 8 months old, but we've got a back test on GCP. Had we done CCP, GCP in equal amounts, the overall returns would have been very nice, right? 21.4%. But again, the real kicker is here. It's the risk-adjusted number that goes to a different planet altogether, right? By combining the stability of America with the compounding of India, you end up with superior risk-adjusted outcomes. Why do you get that, right? There are 3 drivers to this. There are 3 drivers to this superior outcome. 1.3 is a great outcome, risk-adjusted. For every unit of risk you're taking, you're getting 1.3 units of return. That's why 1.3 is a great outcome. Or if you don't want to look at it in a sophisticated way, 21.4% is also a great outcome. Now, there are 3 things that are happening here. The Indian and American stock markets actually have pretty low correlation. At the index level, the correlation is as low as 0.3. At the GCP, CCP level, the correlation is a little higher, 0.38. But the low correlation, 0.38 is low correlation. That's what gives you the diversification. Ideal would have been 0 correlation. If the 2 markets were absolutely uncorrelated, 0 correlation, that would have been perfect. But hey, that's unlikely. Even art and the Indian stock market or art and the American stock market would have some correlation. But 0.38 is a good place to be. That means low levels of correlation. That gives you diversification. The second reason having an Indo-American portfolio juices up your returns is the currency effect. Typically, when the Federal Reserve hikes, the dollar appreciates, the rupee depreciates, foreigners run away from India, the Indian stock market struggles. Those of you who are clients of Marcellus would have seen this through FY23 when foreigners run away, portfolios like ours struggle. And therefore, in that circumstance, when the Fed is hiked, rupee is depreciating, dollar is appreciating, CCP is struggling, GCP will come home with returns because the dollar effect will give you currency depreciation, which will juice up your rupee returns, right? So this piece, I don't think we modeled it by, I didn't think we did it by design. Through serendipity, through our own experiences of global investing, we realized this works very nicely. We're in difficult times for CCP. The rupee is depreciating, and that juices up the returns from our global portfolio. But there's a final layer. There's a final layer, and perhaps the most important reason why those who are listening should run an Indo-American portfolio. It's highly likely, I think almost inevitable, that you are joining this webinar through a imported laptop or phone. The technology on that, the software on that will be most likely an American company. The hardware in that, the chips inside it, the circuitry inside it will also almost likely to be an American company. It's also likely that the car you will drive home today in will have imported components in it. It's also likely that when you get home, the entertainment you'll watch will be an OTT channel where the content is primarily American. And what you will see, and what we have seen in the last 3 years, is increasingly the spends that we make as Indians is effectively on foreign companies. Very little of our spending actually is now domestic companies. To the extent we have domestic spending, it's on financial services, it's on FMCG, right? Paints, adhesives, tail, sabun. It's on dawai, right? Financial services, FMCG, and pharmaceuticals. Those are primarily the areas where we do domestic spend. For affluent Indians, a bigger and bigger slice of their spending is effectively dollar-denominated spending, right? Just because you buy an iPhone in an Apple store in India in rupees doesn't mean it's rupee spending. Effectively, your liabilities, your spending is increasingly going to be in dollars, right? If you send your kids abroad to study, it's explicitly in dollars. But even if you don't send your kids abroad to study, but you buy your kids an Android phone or an iOS phone, effectively your liabilities, your spending is in dollars. If you're spending in dollars and saving in rupees, that's not a very clever thing to do. Broadly speaking, your asset allocation should be in broadly the same currencies in which your spending is. And since increasingly your spending is in real terms in dollars, you should align your assets and your liabilities from a currency perspective. So if I'm going home and watching Netflix, then I'm shopping on Amazon, and then I'm using Microsoft Office to do this software, and I'm using a Microsoft Surface, which I am, right? And basically my life is dominated through foreign spending, and my investment allocation should be proportionately adjusted, which is what we have tried to do in Marcellus, right? One of the reasons for launching Global Compounders was for wealthy Indians, having a hefty foreign allocation makes a great deal of sense from an asset liability matching perspective. So that's the background, right? Doing this combination makes a lot of sense. Just again, so that there'll be a lot of people who do index investing in America or India. I'll once again do the comparison for you. This is what the index would have done. This is S&P 500 Nifty, 13.9% returns over a 20-year period, 0.95 in terms of risk adjusted. This is the index level, right? For those who are fans of efficient market hypothesis, this is what the index would have done for you. And this is what active investing done reasonably well, right? And this is, remember, after a rough 18 months for CCP, this is active investing. You get a better outcome, whether you look at raw returns or risk-adjusted outcomes, right? So that's the backdrop. Now, what exactly, for those who haven't yet been exposed to what does the Global Compounders portfolio do, why has Marcellus built it, I'll request my colleague Arindam to take you through the Global Compounders construct. Then we'll move to CCP, folks, and we'll look at performance on both CCP, GCP. Thereafter, we will shift to looking at other Marcellus portfolios. Over to you, Arindam.
Thank you, Saurabh. Great. So for the uninitiated, I'll just give a brief background. So what are we doing with CCP? We are basically trying to find out some of the best run franchises across the globe, and which are run by exceptional managers. So it's the basic crux of it. You find great companies, put your money there, and they will do their job. Now, for the sake of simplicity, we kind of divided the portfolio in 3 buckets. We call them pick and shovel, utility and consumption. So pick and shovel is the biggest bucket that we have. It is around say 40 to 45% of the portfolio of GCP. Utility is around 30 to 35, and the rest is consumption. So when you think about pick and shovel, basically you're talking about companies which are not making the end products. I mean, Saurabh already talked about ASML, the importance of ASML to the globally. So what ASML does is they make the lithography machines. So the lithography is a process which is essential for any chip manufacturing. So for any chip that goes into your phone or a laptop, it is highly likely that has been made by a machine that has been manufactured by ASML. So they have around 80 to 100%, 80 to 90% market share broadly. In the latest generation of chips, they have almost a monopoly. Now, what it means is, irrespective of whoever is winning market share, for example, if Apple is winning market share or Samsung is winning market share in mobile phones, it doesn't matter. As long as you believe that the world is going to be more digitized, you're going to use more and more sophisticated computing or, kind of more high-end chips, those are likely to be manufactured by ASML. So that is the basic, investment thesis on ASML. Now, how they kind of, build the moat, etc., it's kind of a separate story itself, but I'll just give you a brief kind of, overview of that. Of course, the R&D power has been phenomenal for ASML. They had around 10% market share 25 years back. Now they have 80% market share. But along with the basic R&D spending that you need to do in any tech investment, any kind of tech company, along with that, what ASML did is they fortified their supply chain. For example, the ASML machine is like incredibly complex, right? It takes 150,000 parts. 50,000 parts are just for ASML. And for many of these companies, ASML has taken equity stake. So what it means is that if someone, even if they're somehow able to copy what ASML does, for example, China tries to hack it every year, unsuccessfully so far. So even if they manage to hack the technology, but for them it is just incredibly difficult to build a supply chain out of it. So on top of R&D, that is the source of their moat, they have built another layer of complexity. And this kind of companies, they have compounded at more than 20% over the last 25 years. And there's kind of, if we see the world like as it is today, and it is going to continue, if you believe that, this kind of companies can, easily compound at mid-teens CAGR. So that is one part of it, of the portfolio. Then the second leg is what we call utility. Now, utility is a little bit different from the traditional utility that we hear about, like, the electricity, gas, water. Those are not utilities that you talk about here. These are the utilities which are, unregulated monopolies in their respective fields. So one example is Intuitive Surgical. They make those surgical robots. They have around 90% market share in robotic surgery. So think about it globally. If 100 surgeries is being done through robots, 90% of them are done through Intuitive's robots, which are, the brand is Da Vinci. In fact, you go in any big cities in India, Mumbai, Delhi, Calcutta, you will see that big billboards, kind of, hospitals have actually advertised that they use Da Vinci machine. So that is the pool. I mean, Intuitive is not advertising for them. It is actually the hospitals are doing the advertisement for them. Now, they build this moat through incredible, R&D capability that they built over the last 25 years. On top of that, they kind of brought in a set of, doctors, like as soon as you get into a medical school, you get to practice in Intuitive machines. And when you come out of the school, you are willing to use those. So that kind of creates the first level of mousetrap. And also on top of that, what Intuitive did is, they kept a track on every hand movements that a surgeon makes, right? So think about it. If you're a surgeon, you're kind of older, you really cannot, operate as smoothly as you used to do, say 25 years like before, like when he was young. But Intuitive machine kind of automatically corrects if there is anything that goes wrong. So that gives you the second layer of, attachment with the surgeons. It is kind of prolonging their careers, right? So this kind of, powerful combination of stickiness and with the reliability that it brings in for every surgeon, and in turn with the hospital, that makes these businesses, very recurring in nature. So almost 80% of Intuitive's revenue come from just selling consumables. Consumables are the stuff which is kind of changed for every procedure being performed using this intuitive machines. So you get that kind of utility characteristic, which is kind of recurring revenue stream. And these are, as I said, unregulated. And right now, for example, just 4% of world's soft tissue surgeries are done through Da Vinci, like the robots. Enormous market opportunity, recurring revenue stream, that kind of makes this kind of utility business model that we kind of pick out here a very strong compounding, machines for our next couple of decades at least. And this third leg is the consumption. Now in India, you definitely hear about the FMCG consumption. It's a great story. India is getting more and more richer. So you get the premiumization, right? You're getting more and more organized, formalized across every sector. But when you're talking about, if you think about the global perspective, we are talking about the luxury, right? So the super rich, what they consume, the companies that make things for the super rich. And there has been statistics. I mean, this kind of, the number of millionaires across the globe, they have been compounding at around 6 to 7% CAGR. Take 10, 15, 20 years of data. And you're serving the needs for these people who are not that concerned about the price. Armis is a classic example. Armis makes those super expensive, Birkin bags. In secondary market, these bags compound their price at around 12 to 14% CAGR. Just think about it. Buy a bag today, use it, get it repaired freely over next, the time you hold it, and the value of your bag is actually compounding at 12-13% USD CAGR. Now, what it makes is that for every launch, Birkin bags get a 6 to 7% kind of price hike very easily. So that makes you think about the volume is growing at 6 to 7, you get 6 to 7% of pricing. That gives you 13-14% top line growth. Bottom line is around 15-16%. They have been doing it for last 180 years. We did actually very interesting webinar for our clients, that talks about luxury, how it has been compounding. Would highly recommend to go and, watch that. So broadly, these are the typical companies, that you see in the GCP portfolio. Saurabh, we can go to the next slide.
Yeah, and just to sort of, this compliment what Arindam is saying, right? I'm sure all of you are reading about how AI and chat GPTs is going to have an impact on the world of generative AI. Now, I don't think anybody can make money from that through the Indian stock market, right? We've got TCS in our portfolio. We hope TCS will get some of the work around AI. But if you want to make money on AI, you need to think about GCP. Similarly, I'm sure you would have heard about the Apple Vision Pro headset. If you go up and read up on it, it hasn't yet been launched in the market. I think they showed it to a few journalists. If you read up on it, you realize that 5 years hence, hardly any of you will be doing this webinar on Zoom. Almost all of you will have something, either Vision Pro itself or something akin to Vision Pro. It's so much of a leap forward in how communication happens over distances. Again, if you want to compound from these sorts of tech breakthroughs, we need global compounders. You need global compounders. And that's where the Indo-American partnership, we the consumers, they the manufacturers, comes into play. And as we are discussing, as the years go by, more and more of this stuff will be made in the areas around Pune, areas around Bangalore, the areas around Hyderabad and Chennai. And therefore, we as a manufacturing nation also prosper.
Yeah, I'll just add another point, Saurabh, given you talked about AI on the previous slide itself. So we already saw ASML. So the point here is that even if you do not know, which company is going to make the best AI tool for different purposes, you need more computing power. That is given, right? Because you have to process the data, you have to do all the kind of, data analysis, etc. And you have to use more and more sophisticated chips. And for that, you need ASML, right? So even if you are not buying, we are not willing to buy, who's making the best AI algorithm, but you have to use ASML. It doesn't really matter, which SaaS company or the software as a service company makes the best AI software. It is most likely that you'll be using cloud platform for that, right? So either you have to use a Microsoft Azure, or you have to use Amazon AWS, or you have to use Google Cloud Platform. So those are the kind of, that is how we are trying to play these broader themes.
Yeah. So if you think about it, Arindam, the hardware, ASML provides the hardware, TSMC provides the hardware, Microsoft Azure is providing the hardware.
Right.
The cloud and the chips and the lithography, and someone like TCS hopefully provides the systems integration and the implementation. So the OPEX piece is our country, the CAPEX and the tech pieces is America. Global Compounders comes into its own, combine that with CCP. You're playing both layers of hopefully the AI revolution.
Absolutely, yes. Now the outcome of what we try to develop here is that we are looking for companies which has a long history and which has long history of profitability. So you're not kind of looking for like SaaS companies that have come out of the garage just 5 years back. We're doing it knowingly, and to your comfort, it is not that you're giving up much of the growth aspect of it because you're looking at older companies. So interestingly, on an average, the GCP companies have almost 60 plus years of age. So they have been there for a long time. The youngest one is around 25 years. But if you just look at these growth numbers, right? So the 5-year free cash flow compounding has been around 20% for any time frame that you look at. The EPS numbers are on kind of the same range. And if you compare that with the S&P, so the numbers are actually almost 3x. Now, if you look at S&P's 5-year CAGRs, the numbers kind of move from 4% to 12%. So that is the volatility that you see in the earnings. But for GCP companies, you see the numbers is between that 15 to 20%, right? This is the kind of consistent compounding that's what you talk about, right? That is the philosophy, and that is exactly what we are trying to do with GCP. We're trying to figure out companies that, irrespective of what happens, for most of the time, these guys should be able to pull off consistently remarkable growth. So yeah, Saurabh, the next one. If you look at the GCP companies, I mean, the philosophy has been fairly simple. As I mentioned, when you get this predictable cash flow growth, right? I mean, that your company is going to grow at 10, 15, 20% every year, then you can plan better. And that's exactly what the GCP companies do, right? So when the free cash flow that is generated, either they have 3 avenues to kind of, use them. Either you do capital expenditure, that is the part of their organic growth. So if you look at most of the companies that you have in our portfolio, on an average, they have a kind of high single digit to low double digit kind of organic growth. The surplus amount, what is remaining, they're either returned to the shareholders through share buybacks. Now, in the US, it is the buyback, the kind of mechanics around buybacks are a little bit more, I'd say, kind of better compared to just giving out dividend. So most of the GCP companies do a very nice job of how they kind of structure their buybacks, right? So either you do it or you do M&A, right? So you find targets where you can actually deploy the capital to generate returns higher than the cost of capital. So for example, we didn't talk about a company called Heiko. So Heiko makes aerospace parts. So they started almost 35 years back, started with single component manufacturing, and through the years, they have acquired smaller companies to build a portfolio of, now they manufacture around 12,000 parts. And in the process, they have actually acquired around 80 companies. So every surplus dollar that they make, they invest into buying newer companies very judiciously, which in turn makes that compounding engine work. So for example, if you take any time frame for Heiko, take 10-year, 15-year, 20-year, 25-year, through that every time frame, they have kind of grown their EPS at around 15 to 20%. And given the market they operate, they're still very, very fragmented. So for example, Heiko just has 4% market share. In the markets that they operate, the longevity, the runway for this kind of growth is very long. So you find all these GCP companies in either of these 3 buckets. Either you're investing fully in your organic growth, or you're returning back the excess capital, or you are doing accretive M&As. So broadly, the construct is that the outcome is, as we saw in the last slide, you get a consistent 15 to 20% growth. So that is the broad construct of GCP. Here we see how we have constructed the portfolio. So you're basically looking at the historical free cash flow compounding and free cash flow return on capital for each of these companies. And there's the basic criteria. That's how we filter the companies. And then we do a lot of primary data research, which my colleague Jaibir kind of developed, like how do you kind of get access to many of these companies, talking to the suppliers, customers, basically talking to the entire value chain. And thankfully, many of these companies, in fact, most of the companies are B2B, with long history, so we get access to a lot of kind of seasoned professionals who have either worked in this company or has been involved in some form, in the entire value chain for the companies that are looking at. So then we kind of try to kind of quantify the outcomes of our findings. That is a separate process, and eventually we do the stock selection, and we have a portfolio tool, and that is the outcome of the entire GCP portfolio. Rakshit, I'll hand it over to you.
So before Rakshit takes over on CCP, just a quick point on that. China used to be the world's fastest growing aviation market. Now the world's fastest growing aviation market is India. I'm sure you've been reading in the newspapers, right? I think between Indigo and Air India, they've ordered something like 1,500 or 1,600 Airbuses and Boeings, right? Now, doesn't matter which airline you fly in India, almost every flight you've taken in your life, the plane would have had thousands of parts. Several thousand parts in that plane would have come from HEICO. HEICO makes a higher ROC than obviously the airlines in our country. Our airlines hardly make any meaningful ROC in excess of cost of capital. HEICO makes higher ROC than Boeing and Airbus. HEICO makes high teens ROC. And that again becomes the nub of why combining compounders from India and compounders from the West is so compelling. Rakshit, over to you on CCP.
Sure. Thanks, Saurabh. Thanks, Arindam. Just a quick recap on, in fact, how CCP as a portfolio has some similarities to what we try to achieve even in GCP, but there are some very interesting differences as well, which the twin engine compounding in effect can provide an investor if you invest in both. So the similarities are just like in GCP, in CCP as well. We are trying to capture high quality monopolists who allocate capital in a very prudent manner consistently over long periods of time. Similarly, in CCP, we do the same. In GCP, it happens at a global landscape level. In CCP, these are more companies catering to domestic consumption, domestic supply side, etc. So those are some of the similarities. There are certain differences in terms of the mega themes that CCP tries to benefit from. So unlike GCP, where the mega themes in a way that we're trying to benefit from are digitization, reindustrialization, or luxury spending, in CCP, they are more about day-to-day essentials, products and services sold to mass market and upward socio-economic households in a very consistent manner, where companies are increasingly becoming monopolistic as industries are becoming polarized in the economy in India, and obviously prudent capital allocation. Now, how do we create this portfolio? So just like Arindam talked about in GCP, here in CCP as well, we have boundaries defined to begin with, things that we will never touch, things that we will not do. There are two very, very strong, clear boundaries in our minds. The first one being around forensic accounting. We have our own proprietary fraud detection framework, which today actually runs on Python code so that it is far more scalable and far more efficient. That proprietary fraud detection framework, it throws out red flags on accounting practices particularly. Separately, there's a governance filter check as well. Any such red flags that we see on companies that we can't explain, we try to stay a million miles away from those businesses. The second boundary, the second filter that we have is history again. History is a massive raw material to our research process, which helps us understand whether a company has been prudent capital allocator for a period as long as 10 years in the past. And if it has been, then we are happy to understand why that prudent capital allocation decision was so consistent in the past. What's the design behind it? In effect, we want to avoid speculation. If a company doesn't have history, we don't want to speculate on a great future. If the company had bad history, we again don't want to speculate massively on a turnaround and hence a great future. So these are things that we want to avoid. We are very clear, and that clarity of thought actually helps protect downside for investors before we start thinking about the upside. And as Warren Buffett said, investing 101, if you can avoid downside, then making money becomes far easy. Never forget rule number one, where rule number one is protecting the downside first. The rest of the process after having protected the downside is bottom-up research analysis. And this bottom-up research analysis effectively is oriented towards figuring out why does greatness exist, for how long will the greatness sustain, and what are the tangible drivers of sustainability of greatness into the future around capital allocation from the balance sheet, and intangible drivers around strategic decision making at the board level, strategic decision making at the CXO level. What gives us confidence that those decision making processes will provide continuity and scalability to the decision making of a business. All of this is aimed to build a portfolio of no more than, say, 13 to 15 stocks, a very concentrated portfolio with low churn. For instance, in the last 18 months, there hasn't been a single change to the list of stocks in the consistent compounders portfolio. Over the last 4.5 years, we have had only 4 exits from this portfolio. So it's a very low churn, concentrated portfolio built around businesses which are increasingly becoming monopolistic and disruptive in their respective industries through capital allocation decisions that provide consistency of compounding of their fundamentals measured as revenues, profits, free cash flows over long periods of time. So that's the sum and substance of the process. One of the biggest strengths of this process is our research analysts. They run around the country, speak to various parts of the ecosystems of these businesses. There ends up being massive overlap at times with the kind of people who give us their money to manage, with the kind of people that we also need to reach out to understand various ecosystems, and that's one of the key strengths. In terms of how the portfolio has progressed, this table gives you a summary. Last 3 or 4 years have been very interesting. We've had lots of different types of crises in the external environment. There was COVID, there was a commodity upswing due to Russia-Ukraine crisis, and so on and so forth. What these companies have done is they have all achieved a very healthy rate of revenue growth, earnings growth, return on capital employed. If you look at FY23, for instance, their earnings growth, their profit growth has been 20%, backed by a revenue growth of 19%. If you look at FY22, they had a very healthy earnings growth, profit growth of 31%, backed by, again, a very healthy revenue growth of 26%. And in the 3 years prior to that as well, the rate of growth of revenues and earnings was very healthy. What's quite interesting is that the share price compounding, particularly in the last 18 months, hasn't matched with the earnings growth. It hasn't matched with the underlying fundamental growth. That has actually led to the portfolio valuations becoming even more attractive compared to where they were 2, 3, 4 years ago. And that to quantify the degree of that attraction, so in the last 18 months, profits would have gone up at a rate of, say, 20% annualized, which means 30% absolute. But share prices in the last 18 months have only gone up by mid-single digits. And that gap of 25, 30, 35% is something that we expect to see narrowing down in future. The main reasons why we expect this gap to narrow down in future is in the last 3 to 4 years, all of these companies have allocated capital in areas which were not available for capital deployment opportunities, which were not available prior to COVID. So, for instance, the rate at which tech investments have been done to automate and digitize the approach towards business execution in the last 3 years, that rate is unprecedented. The rate at which M&A has been done in some of these cases to add new revenue growth drivers, to add massive muscle to the existing core business is unprecedented. And all of that is yet to fully show its result in market share gains, which is what we expect to continue to see in the next 2, 3, 4 years. and hence expect the valuation disconnect that has emerged in the last 18 months to narrow down. Last 2.5 months have seen some of that narrowing down. If there are no black swan events, we expect to see more of that in the months and quarters to come by. So that's on the fundamental side. Saurabh, should we go to the next slide?
Sure. So folks, just wanted to sort of show you the double engine compounding in terms of practically what can we offer you. Rakshit discussed CCP, as he mentioned, performance has picked up since foreign investors started returning this year. I think, Rakshit, this fiscal CCP is up what, 13%? 13%
with a 6-7% alpha.
Right. So last fiscal, FY23 CCP was down 15, and this fiscal in whatever 10 weeks or so, it's up 13. And that's why you can understand why we don't get too fussed about stock prices, right? Most people in India invest in a portfolio when it goes up like a rocket. We can't stop them from doing it, but at the same time, we as investors don't get too worked up about what's the latest 1 month, 3 month, 1 year return. Our job is, as Rakshit and Arindam were explaining, our job is to focus on companies that can keep their businesses chugging away at 20%. And if you keep doing that, you do that, we do that, keep looking for businesses which can chug away at 20% year after year, you'll come out smiling. What will hurt you is if you invest in the hottest stock of the last 12 months, basically driving a car by looking at the rear view mirror is seldom a good strategy. So CCP is the right-hand side of this portfolio. These returns are net of fees, net of all costs. And similarly for GCP here, Global Compounders, returns of net of fees of cost. Global Compounders was launched in October. And Global Compounders is run out of Gift City as a PMS. CCP is obviously run out of Mumbai as a PMS. So that's the first piece. 1 second, let me just see. Actually, on CCP, anything else we need to discuss, or should I move now to the other portfolios? Anything else?
We can move on to the other.
So let me then bring up the other deck for the other portfolios. So we'll now do the other portfolios. CCP, this slide Rakshit's already taken you through in terms of the improvement, the steady fundamentals and the share prices. So let's do Little Champs. Ashvin, do you want to take our audience to Little Champs?
Yeah, thanks, Saurabh. Thanks, Rakshit. So the commentary on Little Champs is not significantly different from what Rakshit talked about CCP. So very great past, as you can see, between FY19 to 22, a period where there were many challenges. There was a macro slowdown, there was COVID and so on, commodity price increase and so on. You'll see that the EBITDA compounding has been close to 20%. And in fact, if you go even past 5 years, 10 years, you'll find that the compounding number will not be significantly different from this. So Little Champs is different from a typical small cap portfolio in the sense that in terms of the consistency of the earnings. So typical small cap, you'll find that there is a lot of volatility in earnings, 2 years great earnings, 2 year flat earnings, and 2 years very significant drawdowns. So Little Champs is a portfolio which is prepared differently from a conventional small cap. The earnings are pretty consistent. FY23 has been no different. In fact, we saw some acceleration in the FY24 compounding thanks to the capital allocation initiatives, which we have been talking about. So on an average, the Little Champs portfolio reinvestments have doubled through COVID than what it used to be prior to COVID. So thanks to that, in spite of the macro headwinds continuing in FY23, you will find that the earnings has in fact accelerated for the portfolio. There are some companies where we'll see that there is a drawdown in the earnings. So Amritanjan, Tarsons, and Vijay Diagnostics. One common factor has been that these companies' earnings got impacted because of the COVID-related tailwinds, which were there in FY22 numbers, that ebbing off. So optically, the earnings for these companies look bad. Also, for this set of companies, world, I think, started believing that COVID will continue for longer than that it actually did. So we had first wave, second wave, and third wave COVID. So there is a kind of excess inventory built in the supply chain, whether it was in the pharma space, which impacted alkylamines, or whether it was in lab consumables, which impacted Tarsons, or even for that matter in the balms space, which impacted the FY23 numbers. for Amritanjan. So there is a double whammy impact. One is the high comparison, YY comparison for these companies, and secondly also volume getting the destocking which happened in the channel, which impacted the volume for these companies. Having said that, when you look the share price return for the portfolio, and when you compare the earnings for the portfolio, there is a huge difference. There's a huge disconnect whether we look at last 1 year share price return and last 2 year share price return. Here also, thanks to this disconnect, we are seeing that Little Champs, when you look at, for example, 1 year forward P for the portfolio, whether it is weighted average or median or simple average, the Little Champs portfolio is right now trading at 28x, which is one of the lowest in the last 3 years. For a portfolio which is compounding at 20% earnings growth, where the ROC is north of 20%, you can actually, it's very easy to conclude that the current valuation is actually a steal for the portfolio. Going forward in FY24, we see a lot of these headwinds which impacted this minor set of companies. They're getting corrected. For example, when we head into first quarter of FY24, we will have a relatively clean base. So when we compare first quarter FY24 with first quarter of FY23, we will be comparing apple to apple. So there will be no COVID revenues, or it will be very negligible in the base. So that is one good thing. Secondly, all of these companies, where there are COVID related headwinds, end of the day, they are catering to resilient end user industries. So people will not stop consuming drugs, pharma drugs. They will not stop going to diagnostics. They will not maybe stop applying balms. So they are resilient end user industries. So demand, once this destocking cycle ends, which we think is just around the corner, the demand for this set of companies should come back very strongly. Fundamentally, the portfolio remains very strong, as you can see.
One point I think worth emphasizing, Ashvin, both on CCP and on LCP, and indeed the other portfolios will show our clients the sorts of earnings growth that you're seeing from these companies, right? Around the 20% mark through COVID, through the Ukraine-Russia war, through 5% hike in American interest rates, the best part of 3% hike in Indian interest rates. The rest of the market is not remotely close to this sort of 20% figure. So a lot of clients tell us, boss, I invested in some other PMS, wo to behtar kiya, why did you guys lag, right? Our response is, don't focus on this, because if this is what you focus on, then again, that's rear view mirror driving. Focus on the engine, focus on the underlying driver of your wealth compounding, which is earnings compounding. And I'm not seeing too many other Indian companies, nor am I seeing the overall index compound earnings at 20%. Indeed, my reading of the Indian stock market over the last 3-4 years has been overall earnings compounding is actually in single digits. And in that context, the sorts of portfolios we have built and that we manage are growing 2 to 3x faster than the market in terms of earnings compounding. That is the driver of your wealth. And if you're getting these sorts of companies with stock prices which are barely moving, which is LCP, CCP also over a 2-year period, the movement isn't particularly punchy. If you're getting companies compounding at 20% with stock prices barely moving, it's to your advantage. That's when you should invest. As you can understand, most Indians do the opposite. They wait for the portfolio to rocket through the roof, and then they come in by their thousands to invest. Should we move to
Saurabh?
Haji, boli?
So, Saurabh, if you go 2 slides back, you can actually see the quantification of this data, this point that you're making, right, between Nifty's fundamental compounding and some of our portfolios is fundamental. Yeah, this one. So if you look at the CCP 4 rows, compare them against Nifty 50 4 rows, whether it be ROCE, which has been twice that of Nifty's ROCE, or whether it be the 5-year PAT CAGR, which has again been 8-9% point higher than Nifty 50 PAT CAGR. This actually drives a share price of any asset in equities, and hence the long-term delta between, say, a Nifty 50 compounding versus a Marcellus typical portfolio compounding run rate differential is driven by the fundamentals.
And this isn't a theoretical point. What Rakshit is saying isn't a theoretical point, which since we've been running CCP for the best part of 6 years. If I take the 6-year return on CCP, gross return, we are actually at the at the 20% figure, 21% figure gross return. From that 21% figure, if you knock off, say, 2% of fees, you get to around 19% return, which is the gross, the net of fees return from CCP over a 6-year period, around 19%. And that, as you can imagine, is significantly ahead of the Nifty. And similarly on LCP, if you were to take LCP over a longer period of time, the underlying earnings compounding, the underlying free cash flow compounding is superior, which in turn drives better compounding. So and you or anybody else is welcome to look at the stock price and jump up and down, but we prefer to focus on fundamentals and drive our investments basis that. Ashwin, Rising Giants.
Yeah, so Rising Giants, the commentary is exactly same as LCP. Saurabh, can we go to Rising Giants slide?
Sorry. Yeah, this is the Rising Giants.
Yeah. So as you can see, again, the long-term fundamentals have been very, very strong. One standout for Rising Giants is that the free cash flow compounding, and we have written about it, free cash flow compounding is significantly higher than the EBITDA compounding, which itself is healthy. So this is one important aspect for Rising Giants. These are the companies which are getting bigger in sizes. They are getting more powerful versus their customers and vendors, and hence able to crunch down their working capital and so on. So free cash flow compounding, we think, will remain much stronger than the earnings growth for Rising Giants. And for FY23, again, same, close to 20% earnings compounding. The stock that you see which are down in earnings, same reason. These companies, the tailwinds related to COVID ebbing off, and again, in TVs, we had the pharma destocking in the pharma supply chain, which impacted the volumes for TVs. Again, as we go into FY24, many of these headwinds are ebbing off, plus RG, specifically for the Rising Giants portfolio. We also see the input prices, not only it has come down, but they are also stabilizing. So we should get the margin support for the Rising Giants companies. And end of the day, portfolio remains in very strong health. Alkylamines, for example, even after having a challenging time in FY23, the ROC was close to 26%. So the underlying franchise remained very, very strong and very ripe for recovery. And as far as share price is concerned, again, the share price tells a different story than what it is conveyed by fundamentals. As a result, we have seen, in terms of price to earnings, we have seen almost a 30-35% correction in the price to earnings 1 year forward because of this disconnect between the share price and the earnings for the Rising Giants portfolio. Yeah, we'll stop here. I think Tej.
So Tej, I'll open up just 1 second. Let me just get rid of the illustrator. Now we'll open up Kings of Capital, and if you could take our clients to that. Over to you.
Yes, again, if you were to look at KCP as well and focus on the FY23 numbers, both profit growth, return on equity is not only in absolute terms quite robust, but also versus its relative history. If you were to look at FY19 to 22 numbers as well, both return on equity as well as profit growth are significantly higher in FY23. The good part about this is that it's broad-based. It's across all portfolio companies. So if you were to look at the FY23 PAT growth number, the lowest number within the portfolio would be say 19%, which is for HDFC Bank. All companies have reported upwards of 20% profit growth for FY23. And this has been characterized by not only strong loan growth, but extremely strong asset quality and margins as well. Also, this is not driven by any significant one-offs. So if you were to look at even the pre-provisioning operating profit growth, which is excluding the provision and provisions, even the pre-provisioning operating profit growth for FY23 has been around the 25% mark. So 25% operating profit growth, 35% profit PAT growth, and about 20% return on equity is what the portfolio has delivered through FY23, and all of this being extremely broad-based. Despite that, we see that there is a gap between the fundamental performance and the share price performance. as you can see that the share price performance is in the low teens, while fundamentals have grown at about twice the pace of the share price performance.
So we'll stop there. Pramod, over to you. Over to you to manage the Q&A session.
Yeah. So first of all, I think the questions around how to go about investing in GCP, both resident Indians and non-resident Indians. So I'll get that out of the way before we get into questions around the portfolios and stuff. So when we launched 3 months ago, we clearly highlighted that we have a PMS option for investments for resident Indians. That's through the Gift City. It's pretty much like our domestic PMS. So that's straightforward. That was always open. And we're glad to announce today that we also have an option for NRIs. We do have a fund structure out of Mauritius. And the reason we're recommending that for NRIs and not resident Indians is, as you know, if you're a resident Indian and you invest in offshore funds investing in international securities, the taxation will be, the capital gains will be at marginal rate. So therefore, the PMS is the preferred route for resident Indians, whereas NRIs can invest across both the fund structure and the PMS. For more details, you can write to sales@marcellus.in, marcellus.in, and we'll be happy to provide you with the exact mode in which you can invest. So that's about the fund execution. Now going back to some questions, sort of the questions around the change in the liquidity environment. We've had the sharpest rise in interest rates in 4 decades now. Does that change anything about this double engine compounding, either in terms of absolute returns from equities as an asset class, or does it become easier or harder for an active manager to generate alpha in a relatively higher interest environment as compared to the last 40 years?
So first off, I think what's really, really startling, right, is what's happened in the last 18 months. I have never seen anything like it in my life, in the sense that American rates have gone up 5%. American rates have gone up 5%, and yet America is at full employment, right? Interest rates in India have gone up 2.5%. 2.5%, remember, is a typical Indian rate upcycle. So in 18 months, we've had a typical Indian rate upcycle, folks. This is really, really important to understand. We've had a typical Indian rate upcycle, typically 2.5 years lagta hai. Is bar, in 1.5 years, we've had a rate upcycle of roughly 2.5%. And yet GDP growth is 7.2, 7.3%, right? Stock market is at record highs. So liquidity tightening, to the extent you and I would have anticipated 2 years ago, we've had a sharper liquidity tightening in the last 18 months, especially up to, say, March 2023. Between Jan 2022, which is when Putin invaded Ukraine and doubled the price of oil and pushed global inflation from 3% to 9%. Between Jan 22 to March 23 is one of the sharpest liquidity tightenings ever in economic history. 5% jump in the Federal Reserve rate, and yet American economy held firm, didn't go into recession. India continued growing at 6-7%. In that context, if you ask me, the 15% pullback in CCP in FY23 and roughly the 20% pullback in CCP in FY23 was actually pleasantly surprising, right? You pump up rates. Now that the effects of war are wearing off and inflation is sub 5% in both America and India, I think they're at close to the 4% mark both in America and India. I think America has had 20 months of falling inflation. In India, WPI, which was the big driver of inflation last year, was WPI. WPI inflation is actually negative now. The odds are relatively high that over the next year, couple of years, interest rates come off rather than go up. So the worst of the liquidity tightening is well behind us. Rightly or wrongly, the Federal Reserve was brought to its senses not by macroeconomic data, for whatever reason the Americans don't have better macroeconomic data than us. I don't understand why, but it is what it is. The Americans were brought to their senses by bank blow-ups. And on Bloomberg, you can track the liquidity in the system. You can track the liquidity system if you're interested. And if you have a Bloomberg terminal, you can track it weekly. Since March, liquidity in the American system has improved by, I think, a couple of trillion, right? And if inflation, which has gone down for 20 months, if inflation keeps going down in America, I presume liquidity improves further, given that their banking system is still fragile, and given that at the retail level, they're seeing a slowdown. So the worst of the liquidity circumstances are behind us. More likely than not, rates are likely to go down. They might not go down next month or this quarter, but given that inflation has cooled off considerably, barring a major supply side shock, I think we are past the worst on liquidity. I'm sure whoever asked the question has seen the implications. As soon as liquidity started improving, foreigners came back to India, and as my colleagues have explained, that had a beneficial impact on the portfolio. Now, let's leave liquidity aside for a minute, because there are many other things which drive stock prices. Most traders believe that liquidity is be all and end all, but for those of us who look at the world beyond liquidity, there are other factors which have resulted in investment returns polarizing. So Henrik Bessenbinder of the University of Arizona published this incredible study 20 years ago, showing that pretty much the entire world stock market returns come from a mere 1% of companies, right? This 1% of companies drive the entire stock market's returns. In India, we have shown repeatedly, my colleague Nandita has shown repeatedly, that just 20 companies drive 80% of wealth compounding in India. And that's not because of liquidity. Henrik Bessenbinder's study goes back 100 years. Nandita's research on this goes back 20 years, long before Lehman, long before the liquidity onrush. The reason returns have polarized, especially in the last 20, 30 years, is because of how technology changes the nature of the modern economy, right? You're not going to have more than one Microsoft, right? The economics of software, the economics of operating systems, especially at B2B level, are such that it's difficult to have more than one Microsoft. It's highly unlikely you'll have more than one Amazon. It's highly unlikely that you'll have more than, say, couple of NBFCs with the tech pedigree of Bajaj Finance. It's highly unlikely you'll have more than 2 to 3 banks with the operational chops of HDFC Bank. The nature of technological change has resulted in brutal profit concentration, both in America and in India. And as I said, Henrik Bessenbinder's famous study shows that the entire world's equity market returns come from just 1% of stocks. You and I, all of us on this call, are searching for that 1% of stocks. We have given you our way of answering the question. Look for clean, well-run companies with ROCEs close to 40%, compounding of wealth at 20%. That's how we identify them. You might have a different way to do it, but that's the ask here. 1% of companies will make all the wealth that exists in the world. Whether the Federal Reserve hikes rates or lowers rates is a secondary matter. That's noise. The signal is the tech revolution. The signal is the concentration of economic power in the hands of a handful of companies.
If I may add a couple of points here, Saurabh.
Sure, go ahead.
Yeah. So if you look at last 60 years of history, right? I mean, we have enough data in S&P 500 or US 10-year Treasury. So there has been times, there has been times when the interest rates has gone up, 70s, inflation was going through the roof, and then again, interest rate coming down. So, but in any point of time, you just take a 20-year block and how the S&P has compounded, it has always been in that range of 8 to 10% USD. It is not a, recent phenomena or anything like that. So that is number one. Number two, what you really need is a stable interest rate. Along with so the two times, the stock market was the best when the interest rate is declining, and you need a steady interest rate. Now, as long as we are not in an environment where the interest rate volatility is very high or it is going up steadily, you are actually, as a stock equity market investor, you're actually well positioned to benefit from the compounding that the stock market gives you. Number three, you asked about the active investing part of it. Now, last 10-12 years has been hard for the active managers, and all the reasons being the liquidity was too high, and every Tom, Dick, and Harry were kind of able to deploy the capital the way they wanted, and in return they could actually make money out of it with high leverage. Now, as an active manager, if you ask me, I would like to see the interest rate kind of stabilize at a very higher level. So that will separate out the good allocators versus the bad capital allocators. And we are looking for good capital allocators, right? Just to give it context, and if we just go back, if you just take the time frame between 2002 to 2007, 8, 9, 10, I mean 2002 to 2010, those are actually golden eras of active investment. And if you look through that period of time, interest rate was actually steadily going up, not by a high margin, but it's steadily going up. Emerging market was growing, etc. So those are time periods actually that helps, that need stock picking. Otherwise, in case of cheap money, you really do not need stock picking. So if the interest rate stays where it is, it is actually pretty good for active managers like us.
Just to sort of, for those who are interested in this, this is the paper, you can find it on the net. Just put long-term shareholder returns, evidence from 64,000 global stocks. The latest version was published just 3 months ago in March 23. Henrik Bessenbinder, Tae-Feng Chen, and so on. And what he tells you, as I said, was, right, just basically 1 to 2% of companies drive the entire wealth creation, right? Drive the entire wealth creation comes from 1 to 2% of companies. So in a world where a lot of people believe index investing is the way forward, this guy's work, and it's very compelling work. This is one of the most famous papers in modern finance. This guy's work is showing was just 2% of stocks make all the money. Every dollar of market cap in the world comes from just 2% of companies. And as I said, our job, your job, is to find them through active investing, rather than focusing on interest rates and dancing up and down with interest rates.
Yeah, sort of a corollary question around that has been, if you just look at the last 6 months itself, the S&P's bounced back 25%. But, there's this study which showed S&P returns with AI-powered stocks and S&P returns without AI-powered stocks. There's almost a 30% alpha, right? So, in fact, S&P XAI is actually down in the last 6 months. It's just a handful of those.
Still in the bear market without AI.
Correct. Yeah. So, so your point about a handful of companies making all the wealth has been sort of turned upside down by this gentleman who's asking the question. If it's just a handful of companies, what hope in hell do we have finding them? Isn't it easier to just buy the whole basket, which is the S&P 500?
So this is why this is where a love of cricket comes through, right? So there used to be a batsman, for those who are my age, there used to be a batsman called Sunil Manohar Gavaskar, right? We were big fans of Gavaskar through the 80s. He was copybook cricket. He used to pace up to West Indian fast bowlers, Australian fast bowlers, and hit 100 after 100. Impeccable technique, copybook cricket. Then a young boy called Sachin Tendulkar from the age of 13, 14 modeled his game on Gavaskar's technique, and he also became a very successful batsman. Then another young man from Pramod's hometown, Bangalore, Rahul Dravid, modeled himself on Gavaskar as well, and surprise, surprise, he also became a very good batsman, right? And then a man called Virat Kohli, a boy called Virat Kohli in Delhi, modeled himself on Sachin Tendulkar, and astonishingly, Virat Kohli also became a very surprisingly good batsman. Young man in Punjab, Shubman Gill, modeled himself on Virat Kohli, and Shubman Gill also became a superstar batsman, probably the superstar of the future. Along the way, there were other stars, VVS Lakshman, Ajinkya Rahane, solid games, well-known batsmen, all play the same way, broadly the same way. Technique, leave the ball outside the off stump alone in test cricket, solid forward defense, and you have the ingredients of a great batsman, right? It doesn't mean everybody who bats like that will be a great batsman. I too had good technique in school, and here I am, right? It doesn't mean everybody who bats like that will be a great batsman, but the odds are significantly higher that if by your mid-teens, you know the basics of high quality batting, the odds become significantly higher that you will go on to compound well as a cricketer, right? Similarly, in corporate life, it doesn't mean that every company with clean accounts and good capital allocation will become a great compounder, but the odds improve radically, right? Remember what Rakshit and Arindam are showing you is that by screening out the crooks and the incompetent capital allocators, you're narrowing down to 10% of the market. From that 10% of the market to come to the 1%, remember Bessenbinder, just 1 to 2% of stocks will make all the money. right? To get from 100 to 10, you use forensics and capital allocation. To get from 10 to that 1 or 2, you use bottom-up research. But if you're broadly playing in the same neighborhood, even if we can't nail every big compounder, even if the global compounders team and the domestic compounders team nails half the compounders, Marcellus's clients are home and dry, right? And that's how cricket batting works. You broadly emulate the greats who have followed a certain technique from Don Bradman to Shubman Gill. From Don Bradman to Shubman Gill, you can trace a certain style of batting, and similarly in corporate life. Great capital allocators, great franchises, great promoters, great CEOs demonstrate certain traits and techniques. They are relatively well known. You just need a degree of discipline to buy a portfolio following those traits, rather than doing what a lot of people do. Last year, crony capitalist and PSU chala. Last year, crony capitalists and PSUs did well. Typically, when the Fed hikes, crony capitalists and PSUs did well. So, boss, why don't you guys in Marcellus have some crony capitalists and PSUs in your portfolio? That's the sort of rear view mirror driving people do. We don't do that. We have an absolute standard around the quality of company we invest in. If we do that, we won't get it right every year, but 4 out of 5 years we'll get it right. And the chances are high that we will be in that magic 1 or 2%, where Best and Binder says all the wealth lies.
Just to give you some comfort, I mean, despite not owning the, like, as you mentioned, like 7 big stocks have drove, like, the entire S&P. So you don't own 4 of them, but still we are actually somehow hanging in there.
Great. So Arindam, I think I'll ask you the question which Rakshit, Ashvin and Tej have answered umpteen number of times in this webinar. Perhaps the most often question is around valuation. In CCP, we've maintained that, buy great companies, by and large, when the stock price is below its intrinsic value. In fact, let me ask this question verbatim. Naveen Jha says, I really appreciate your process and have full trust on your system and process. However, I have my doubts on valuation of the stocks based on free cash flow and DCF. I understand we make money not by buying great companies at high prices, but great companies at fair prices. So he's requesting your comment from a GCP perspective. And there's a corollary somebody else is asked, who's saying, shouldn't we wait for the earnings to bottom out, given that S&P is going through a earnings recession of sorts? So timing versus pricing, what frameworks do you have in GCP that takes care of these sort of situations?
Right. Yeah, that's a great question, Pramod. So the two steps to it. So when you are selecting a stocks in the GCP portfolio, we have a strict valuation criteria. So we kind of, so my colleague Javid developed a framework which looks for the, based on the current price the stock is trading at, what is the kind of free cash flow growth that stock would need to justify that price. Now, so that is while buying a stock into the portfolio is step one. Like when you have this 25 to 30 stock, we kind of just boil down the entire portfolio to 25 to 30 stocks. So that is the entry criteria on valuation that we have. Now, once the stock gets into the portfolio, then we did develop a portfolio tool called TOR. Now, we definitely acknowledge that, buying great companies at any price, it can be painful for a number of years, right? I mean, NASDAQ is a great example, as you might know. It took 15 years, like someone who bought the NASDAQ index in 2000, the peak of 2000, then it took 15 years for them to get back their money. We acknowledge that. And as a result, what we did is we try to identify if there is certain kind of, divergence or what they call, dislocation that is happening in the market. And if any of our stocks, can be, can fall prey to that kind of dynamic. So we think we have a robust kind of approach to identify those kind of extremes. And also, if that happens, you also look at the valuation, both on the relative term as well as the DCF based way. Now, the DCF is not the traditional DCF. It is a kind of relative to market DCF. It's kind of, a concept which is hard to explain over a webinar, but we are cognizant of the valuation kind of challenges that might arise. We are not going to buy growth at any price. That is not going to happen. So we keep on, resizing the portfolio positions, basically, of certain stocks. Now, on the second part, what is the second question, Pramod? The timing aspect, right?
Timing aspect, yeah.
Yeah. It is just hard for us to do. I mean, we do not have any kind of crystal ball per se. Typically, what I have seen historically is that 2 quarters before earnings really troughs, stock market starts to rally. But that doesn't mean that we know that market has already, the earnings have already troughed. So the market is kind of pricing in some of it. It's very hard to say. So I'll not take a call on that. Now, another aspect I will add to the valuation angle. So right now, for example, the portfolio is trading at I think 33 times price to free cash flow versus S&P's 23 times, 24 times price to free cash flow. Historically, what I have seen is that when the relative valuation goes to say 1.6 to 1.7x, that is when a portfolio kind of gets jittery. Right now, we are very comfortable. It's just 1.4x. So we are not that kind of concerned about the overall valuation of the portfolio. So yeah, I think that's JB, you want to add anything?
I think you covered it well. Just elaborating on the entry criteria framework that Arindam mentioned. When we look at that implied growth number, what we compare it to is two things. One is history, that's straightforward. The other is what our expectation of the next few years is, which is harder. We're cautious, conservative people, so our expectation of the future is always a little worse than the past. So that in a way creates that barrier which Arindam was talking about.
Great. So on that note, Rakshit, Ashwin, Tej, if you could also comment on where valuations stand for each of your portfolios. Clearly, the numbers that you showed suggest that there has been a massive derating in each of your portfolios, right? If earnings are up on an average 20-25%, and this is annualized. So for over an 18-month period, you're actually up 30%, whereas most of your portfolios were down anywhere between 10 and 20%, which means that you should have seen a derating averaging 30-40%. But what are those numbers exactly? And is there a similar number that we can give to what Arindam said, vis-a-vis the index? Obviously, these sort of companies will always be trading at a premium to the index. Where do we stand compared to history?
Sure. So let me kick off with a few quantification data points on CCP. So CCP currently on FY24, which is sort of half-year forward earnings estimate, is trading at 33 times, 34 times price to earnings. On the same metric, 2 years ago, 1.5 years ago, valuations were around 51, 52 times price to earnings. So from 51, 52, it has come down to low 30s. If you look at the last 7-8 years average for the same portfolio, using today's portfolio allocations, the weighted average price to earnings multiple for this portfolio would have been in the high 30s, 38 to 40 times. So that's those are 3 data points: 38 to 40 long-term history, 51, 52 18 months ago, and low 30s today. And I'll just share one other quantification before I pass it on to Ashwin and Tej. So there's a very nice book called Expectations Investing by Michael Mauboussin. The first edition was published in the mid-90s, I think, and the revised edition came out 3 years ago. And Michael Mauboussin, for those of you who know, is a very deep thinker on concepts, including valuation. That book has, in a way, given a very simple framework, which says that, look, if you sort of look at a DCF and just say that put in the current share price, your expected rate of growth of fundamentals, free cash flows typically, The DCF can be used to just back calculate how many years of compounding at that rate of expected growth is baked into the current share price. So let me quantify that, right? And this is a very simple exercise. Let's assume that in a typical CCP company or in a typical Marcellus portfolio company, if the business is going to compound at, let's say, a terminal growth rate of say 5%, which is inflation, and no volume growth, there is no fade assumed in the DCF, so there's none of that financial engineering being done. There's a 5% terminal growth rate. You use a 12% cost of equity. If a business compounds free cash flows at 25% at 40 times price to earnings, I repeat, at 40 times price to earnings, a 25% free cash flow compounder is baking in around 9 years of compounding, right? And again, I'm repeating, using 5% terminal growth, using 12% cost of equity, 25% free cash flow compounding, 9 years of compounding is being baked into the share price, after which the terminal growth applies if the PE multiple is close to 40 times. And here is the flip side. So if instead of 25%, you expect actually 15%, 15% free cash flow compounding, right? Then at 40 times price to earnings, you are baking in 26 years of compounding, right? And this is simple math, 26 years of compounding instead of 9 years, if you just change the free cash flow compounding run rate from 25 down to 15, right? So that's where, if you've got, let's say, a Colgate Palmolive, a Castrol, where the expected compounding is low teens at best, mid-teens, right? A 40 times is super expensive. But if you've got a 23-25% compounder, right? And if you expect the company to continue to remain strong beyond, say, 8-9 years, then a 40 times can also be cheap. So bear that piece in mind. It's not just that every 10 times PE multiple is cheap and every 50 times PE multiple is expensive. You need to contextualize this, and this is not science that we have defined. This is something that has been in existence for several decades. So I'll just pass it on to Ashvin and Tej on that.
Yeah, quickly for the rising edge portfolio, the weighted average 1 year forward PE has corrected from something around 50x to now in early 30s. So there has been a steep correction in the PE. For the little champs at peak, we were at 40x around a year back. Now we are at, as I said before, we are in 27-28 zone. And if we apply Rakshit, what Rakshit talked about, I think LCP, the market is building only about 5-6 years of compounding. So that is what we are.
On TCP, we are at about 21 times forward earnings, and this used to be around 35 to 38 times about 18 months ago. So while, like we saw on the screen, profits have compounded at about 25-26% over the past 18 months. This is compounded. Share prices have not moved in line. Also, there is, if we look at individual names, there is a lot of discount that we see even versus historical valuations. HDFC Bank over the past 20 years versus today, or a Kotak Bank over the last 10 years versus today, trading at a significant discount, despite fundamentals, which is return on equity, return on assets, and growth being equal to or better than their history.
Folks, just for whoever is interested, including the person who asked the question, on our website, we've published this blog. You can go and read it. It's on our website. What they don't tell you about high PE stocks, just go to marcellus.in. All our research on our website is free. And what we made the point is, a lot of people in India get very, very excited about high PE, low PE. Their whole life is spent around agonizing about PE. And we've given you data for long periods of time as to why we've taken a bunch of high PE stocks from 10 years ago and shown you the stocks that were high PE then have ended up becoming very good compounders. In fact, more often than not, high PE stocks from 10 years ago have ended up giving great returns. And the point we're making is PE multiples have very little embedded information in them in the Indian context. We used a very simple company as an example, Nestle. We showed you Nestle. We show you in the blog Nestle's PEs were very high then. A lot of people said don't buy Nestle 10 years ago. We published this blog on 17th March, right? We published this blog on 17th March this year. A lot of clients wrote in, a lot of non-clients also wrote in to say, boss, Nestle abhi to chad gaya hai, fully valued hai, high PE hai. It was ironic, right? We wrote a blog on why high PE based investing, there is no problem with it. People still got worried. They wrote in to say Nestle ka PE high hai, and then Nestle went on to have good results. They announced further capex, and the stock has gone on to do further. Stock has gone on to do well further. So by all means, check PE multiples. Ask us. We will tell you, as my colleagues told you. But the notion that you or I or anybody else in India is going to make money by staring at PE multiples defies logic, defies common sense. And feel free to read up on it on our website. Back to you, Pramod.
Right. I think this is an interesting question. So while others have asked about the $31 trillion of debt the US government is having, whether all these bilateral treaties moving away from US dollar-based trade and puts the US dollar as the reserve currency status. But here's the most, I think, relevant concern, which Arindam, if you can address, that most of the West is an aging economy. Presumably, growth will be slowed. Why do you want to bet on it rather than a much younger and a faster growing economy like India?
Yeah, I mean, great question. And we're not telling you to bet against India by any means. So, I mean, it's one of the great markets to be in. What separates out America is, how they've institutionalized the remittance system, actually. So, for example, I mean, in our GCP slide, actually, we used to show that, over a longer period of time, I mean, US GDP growth has been around 5%, 4 to 5%, somewhere like that, nominal GDP growth, whereas the S&P return has been around 9 to 10. Now, what the American companies typically do, I mean, they kind of tap into the best performing or the best highest growth market. So, for example, if you think about, say, Honeywell or any big conglomerates or even the Boeings of the world, I mean, you can see them, they are very dominant in the emerging market. So they get the best growth out of the emerging markets. That is number one. And number two, if you look at, the disconnect between the GDP growth, nominal GDP growth and the S&P, it is very unique to America. So over the years, if you look at how the index composition has changed, that is actually kind of quite fascinating. So if you go back to 1980s, 1990s, you'd see that there are a lot of banks out there, right? The JP Morgans, the Goldman Sachs of the world, they'll be having the top companies. And then you came to the, say, late 90s, it was the Exxon Mobils of the world. And if you go back, say, 100 years, it was the Standard Oils of the world who was kind of ruling the S&P 500. So now it is all the Apples and the Googles of the world, right? So this is kind of classic free market economy that you see in US. So every time we go through this transition, be it from economic growth driven things to commodity growth, the US market kinds of readjusts itself very quickly. You cannot say the same thing about any other country in the world. So if you look at FTSE, the UK 100 or anything like that, you'll always still see the highest index weights are with the big banks in UK. So US kind of has this kind of free market economy, that kind of readjusts itself automatically, actually, in any point of time. Give them 5-6 years. It will make sure that the best growth names are part of your index, right? So the investment implications is very disconnected with the GDP outcome. So for example, right now, I think S&P is like 25 to 30% is in tech, which is again asset light. You do not need your young people per se, to help them grow. So you have this 25 to 30% in tech, you have around 15-20% in healthcare. So basically the things that you're talking about, that aging demography, etc., the market is already adjusted, in the market cap weights that these are the good players. These are the companies that are going to thrive in our next 10 to 20 years. I don't know if that answers your questions, but broadly, I mean, the West readjusts itself pretty quickly with changing.
I think Arindam, also worth saying, although 85% of the GCP portfolio is stocks listed in the US, at the portfolio level, what percentage of the revenues for the portfolio companies comes from what region? And that should take care of the growth question.
So yeah, that's a nice point. So around 50 to 60% of the revenue is from outside the US, probably 40% from just emerging market, but importantly, almost 65% of the growth is coming from emerging market. Yeah,
so I mean, that's the best part of America. I guess these are truly global companies. They're not just dependent on the West or the rich world for growth. In fact, like Arindam mentioned, more than 2/3 of their growth is coming from fast-growing economies like India, like China, Southeast Asia.
As we get richer, that will even more be the case, right? As we get richer, right? People on this call are not going to buy more Dawai and more FMCG, right? As we get richer, people on this call will buy more iPhones, more tech, more electronics. They'll go on more holidays abroad. As we get richer, even more of our growth will go to the global compounders than the local compounders.
Right. I think lots of people have asked lots of questions around the specifics of the GCP fund and PMS structure, the capital gains implications, the tax collection at source. We've noted down your names. We'll be reaching out because these questions are specific to your situation. But for those who haven't left the details, please do write into sales@marcellus.in. We'll set up a one-on-one call with you to take you through the modalities. But thanks for dialing in. It's been more than an hour and a half. Look forward to seeing you all in the next webinar. But if you have specific questions on the portfolio or how to invest, please do write into us and we'll be more than happy to engage. But thank you all. Thanks to all our fund managers and Saurabh. Thanks for your time.
Thank you.
Thank you.